Morning, everyone. Thanks, Adrian. The most important bits of information so far this week, really, we had on Wednesday, which was both the trade balance. I'm just scrolling down here. The trade balance came in as expected. It's still a whopping trade balance, but it is shrinking a little bit, and this is largely due to the fall in oil price over the last quarter, which is reflected in this slight contraction in the trade balance of 48.7 billion. Yes, it is quite a big number. Other than that, the most important bit of news that the markets were looking at is the FOMC minutes. This is the Federal Open Market Committee. This is the rate-setting committee of the Federal Reserve, the US Central Bank. It's the equivalent to our Monetary Policy Committee here in the UK. The markets do tend to get rather stressed with announcements and minutes from central banks, and the FOMC is no different. In fact, if anything, the market is hooked on credit. It's hooked on easing. It needs the stimulus. We've had a number of rounds of quantitative easing. We've had the moves from the from the Eurozone, from the UK last week, further QE. We also had a cut in Chinese interest rates. There's been a lot of central bank action taking place, and the markets, well, I looked at the global stock index, the FTSE All-World Index, is down again for the 7th consecutive day. That doesn't mean all markets are down. It takes all of them, provides all the indices, the global indices, and produces a global index, as it were. FTSE obviously hasn't been falling for 7 straight days, but it's interesting to see the moves in the markets following all this central bank intervention. There is very, very disappointing reactions all round, really. And the news from the FOMC was not really what the markets were looking for. The markets had been really wanting to see some signs from the minutes from this meeting that would suggest there is going to be an imminent bout of quantitative easing, some more narcotics for the patient, really, being the economy. And I just don't think, the Fed provided the encouragement that the markets were looking for. And as a result, you saw a pullback in stocks last night, and also a pullback in the euro or a rally in the dollar. And I think that rally will probably continue, to be honest. I think it's likely that with what's going on in the Eurozone, and now with a lack of any clear direction of further stimulus in the US, it means that without further QE, the dollar will continue to strengthen. I suspect this trend will continue. I have no reason to doubt that we'll see this market at some stage dip below 120 against the euro. Okay, the news from the FOMC, and I'll just read bits of it from one of the news was, there was a strong bias, or a bias to stimulating the US economy if, and they keep on using these words of if economic data warranted. A few of the 12 voting members, so there's 12 members of this FOMC committee, thought that further policy stimulus likely would be necessary, while several others said it might be needed if the economy lost momentum, risks to growth were worth, or inflation looked to remain below target. So it's all a bit pretty disappointing, and that's the reason why you've seen these sort of moves that we've seen. If I look at the US Euro USD, this candle here last night, this was the immediate reaction following the news. So you can see that we've had, it's just generally been perceived as disappointing. The other things that the Fed discussed that were minuted, as we know, they decided to extend Operation Twist. This is just a technical sort of action where they're attempting to lower longer-term rates, where they sell short-term securities and buy securities with longer maturities. And that basically causes the yield curve to twist a little bit, whereby short-term rates go up and long-term rates go down. Obviously, companies, a lot of loans, etc., are longer term, and it's that is designed to try and help the longer end, to help companies, etc., when they're borrowing money. Okay, so that's really what has gone on. Overnight, we've had some news. Let me just now go to the calendar, because I heard Adrian talking about this. First of all, the surprise overnight, the South Koreans unexpectedly cut interest rates. Now, the reason why I'm mentioning this is because I know none of you trade the South Korean won. I'm not suggesting anyone even trades the Kospi, which is the South Korean index. But it's just interesting to see that was unexpected. It's more central bank intervention. Really, the picture starts to get gloomier and gloomier if you're an investor. For us traders, we're quite happy seeing this. We don't like too many surprises, and for any of you who were trading the Aussie dollar, I'm amazed, actually, the Aussie has recovered as much as it has done, to be honest. But for those of you who were trading the Aussie dollar, and I hope to God none of you were up at 2:30 in the morning, although I have to confess I was up at about 3:15. But I saw the news, the unexpected rise in the US jobless numbers, and I think what all this tends to tell me is that the global economy is faltering. We don't have the emerging markets support anymore. There is clearly a problem in China. There's clearly a big problem in Brazil, India, etc., etc. And these emerging markets were the sort of backstop whilst the Eurozone and the US sorted out their own mess. Now, obviously, that's not happening. And so really, we're back on sort of this risk-on mode, risk aversion, where we're looking at the falling commodities, which affects all those growth-sensitive currencies, so like the Canadian dollar, like the Aussie dollar, the Brazilian real, the Indian rupee, etc. So they've suffered quite a lot. And obviously, on the back of that, where does the money go? Well, the money's going into fixed income, that's bonds. So you've got the US bond yield. So when we talk about bond yields, obviously, they're a debt instrument. They have a yield, i.e. if you own a bond, it pays a coupon, half yearly or yearly. And it's the yield on these that has continued to fall as more money piles into bonds or fixed income, because they know or investors know that their money is safe in bonds, it's not safe in equities. And so this risk aversion is building again. As I say, the US bond yield, so that has contracted by another 2 basis points. So the yield on a 10-year US bond is now 1.5%, which is only 6 basis points or 0.06% above a record low. And yesterday we also had risk off. Charles Griffiths, risk off, risk aversion. That's correct. Risk off means if investors are not engaging in risk, we call it risk off. Risk off means investors tend to sell equities because they're riskier assets. They buy less risky assets, which are bonds. They buy less risky currencies. Believe it or not, the world's reserve country, they buy the US dollar. Our gilts have been a beneficiary. We are seen as a safe haven. God, you wouldn't have said that a few years ago, but no, the UK gilts, the sterling is deemed to be a safe haven. So we've also benefited. Our borrowing costs are significantly lower than the likes of Spain and Italy. God knows, had we fallen into the dark side and joined the euro when it was all up in the air, we would be in a worse position than Spain. Can you just imagine that? So that's risk off, Charles. Yes, very much risk off, risk aversion at the moment. German Bund yields, just extraordinary. There's another beneficiary. So a lot of people who have to keep money in euros, they're piling into the German Bund. And the yield on the German Bund, the German government can issue 10-year bonds, and they only have to pay 1.2%. Which is just extraordinary. So really, it is a pretty dire time for investors. As I say, this is the reason why we are traders, and it's a great position to be in, to be able to make money on the short side and to be taking advantage of these moves. Is gold losing its status as a safe haven? If so, what's driving it? Charles has asked, gold losing its status as a safe haven. Charles, I'd respond to that and say a lot of markets tend to look forward and anticipate moves. Gold has had a considerable move. I mean, if you look at it, let's just put up gold here. I hope you can still see all these charts. If I look at gold, make sure I get the right one so you can all see it. Okay, this is gold. If I look at this over the last, well, let's go back on a monthly chart. There you go, Charles. That's a monthly chart in gold, and we're going back to over 10, 12 years here. Gold has discounted what's gone on very much since the start of the credit crunch in '08. Gold has more than doubled in price, and so it actually has discounted, it's priced in a lot of the sort of woes that have happened. It's similar to what happened in the 30s after the stock market crash of '29. There was a distrust of currencies, and so investors bought gold as the only sort of place, and you talk about a safe haven. Gold is a safe haven. Big problem with gold. Of course, gold depends on someone else buying it at a higher price for you to make money. It doesn't pay a dividend, has no yield, so it doesn't pay any earnings, etc. It's not a bond. It doesn't have a coupon. So it very much, you have to have the price rising to make money out of it. I think what's actually happening at the moment, Charles, it's more likely that the rally in the dollar, the continued strength of the US dollar, is putting more pressure on gold than the allure of sort of being a safe haven. I think the safe haven argument will continue to hold sway, but I think, in the short term, there's some big owners of gold. Some of the, there are, the Poulsen Fund, that's got anything up to about 100 tons of gold. So there's been some massive positions in it, and I think as the dollar strengthens, obviously being a dollar-based commodity, any dollar-based commodities, whether it's copper, lead, gold, silver, platinum, palladium, priced in dollars. In dollar terms, if the dollar rallies, those commodities come off. That's just logic. So, in answer to your question, it hasn't lost its safe haven. The driving force for now will be the rally in the US dollar. Adrian's looking at me. I think he wants me to wind this up and pass back to you. The last bit, I just want to recap on what we've got coming out for the rest of the week. The Japanese interest rate decision, for any one of you who were up at the middle of the night as well, there were no further stimulus from the Japanese central bank, so nothing happened there. We've got the regular weekly unemployment claims at 1:30. Again, unemployment or employment is just not picking up fast enough in the US. With a rising population, we saw the numbers from the May numbers, 69,000, far too slow to keep up with a population growth. So that's the reason why the unemployment rate will not come down if we only have that sort of pace of payrolls. So unemployment, that's always a weekly number that does stir a little bit of interest, of course. Then we have the federal budget deficit. That's this evening at 6 o'clock. Just having a look. Is it on my calendar here? Okay, yeah. Okay, it's 7 o'clock. I do apologize. I got the wrong time. So federal budget deficit. So that comes out at 7 o'clock. For any of you who are trading all day, I really think extending your trading day right into the evening as well. Probably best hang your boots up by then, I guess. And then tomorrow, although I won't be around, I'm leaving. Adrian was slightly incorrect. Whilst I would buy euros if I had to go to the Eurozone, I'm not. I'm going to Turkey, so it's the Turkish lira. But anyway, that's one correction for you. PPI we've got tomorrow, and also the University of Michigan Consumer Sentiment. This is the prelim data, quite interesting. We do need the the US, one thing that has been fairly robust in the US is the consumer sentiment, and that's something that, if it comes in as expected, it's fine. But if it looks to suddenly weaken, then that would cause a little bit of a wobble in the market. It dropped in June compared to May's number, so we would like to see it sort of hold a little bit here, but it has been declining a little bit. Other than that, as I said, you've got the PPI, that's Producer Price Index. That's what that's the sort of there's the cost of production rather than the actual retail price index. And we're looking for a fall of 0.5%. That is it. Thank you very much for listening.